A staggering $3.73 billion GAAP net loss just hit the wire. Yet Intel's core segments are surging at an unprecedented pace. But does this brutal bottom line collapse mean the legacy giant is dead? Or is a historic turnaround quietly trapping the bears? When doing stock market analysis, you must look beyond the surface-level headlines to find the truth hidden within the actual balance sheet. Total revenue hit $13.6 billion this quarter, delivering a year-over-year revenue growth of 7.2%. Wall Street looks at this total revenue beat and assumes the legacy chipmaker is effortlessly reclaiming its throne. We see data center and AI revenue growth soaring at 22%, confirming that Intel is capturing emerging demand with advanced architectures. Simultaneously, Intel foundry revenue growth clocked in at a highly impressive 16%. These top-line growth metrics paint a vivid picture of a company executing a brilliant strategic pivot toward custom silicon. But when gross capital expenditures consume $4.96 billion in a single quarter, the bullish narrative immediately fractures. Capital expenditures simply represent the massive cash a company spends to build or upgrade physical assets. This immense $4.96 billion capital drain proves that buying top-line market share requires bleeding monumental amounts of cash. In any investing strategy, accelerating top-line revenue metrics are meaningless if the internal friction required to achieve them destroys corporate value. To fully grasp why Intel is burning so much capital, your fundamental analysis must look at a horrifying discrepancy buried deep within their profitability metrics. Non-GAAP net income printed at a respectable $1.48 billion, projecting an image of stable operational control. Non-GAAP metrics are basically management's customized version of earnings that conveniently excludes one-time messy expenses. The financial media immediately grabs this non-GAAP net income and praises Intel for delivering a solid, fundamental bottom line. They point to the positive non-GAAP operating margin of 12.3% as definitive proof of disciplined execution. But when you look at the unadjusted GAAP net loss of $3.73 billion, the illusion of profitability instantly shatters. GAAP stands for Generally Accepted Accounting Principles, which is the strictest way a company must report its true profits. This massive divergence is driven by a severe restructuring and impairment charge of $4.07 billion, primarily wiping out goodwill tied to the Mobileye unit. An impairment charge simply means the company is officially admitting an asset they bought in the past is now worth drastically less. By taking this $4.07 billion hit, Intel incinerated over a quarter of its revenue on paper in a single accounting stroke. In any sound investing strategy, this is where you learn never to accept adjusted net income metrics at face value without inspecting past capital allocation mistakes. This brings us to the real elephant in the room regarding how Intel actually pays for this incredibly expensive structural overhaul moving forward. Adjusted free cash flow sits at negative $2.02 billion, proving that the bleeding is far from over. Free cash flow is simply the actual cash left over after a business pays for all its operating expenses and factory investments. Surface-level analysts celebrate this negative $2.02 billion because it represents a year-over-year adjusted free cash flow improvement. But when gross capital expenditures consistently hover near $4.96 billion every 90 days, that cash burn highlights the astronomical cost of building a global foundry network. Intel is locked into a high-stakes capital intensity trap, where they absolutely must bleed cash today to secure tomorrow's market share against external competitors. This is exactly why relying on top-line revenue metrics alone is dangerous when the underlying free cash flow margin sits at an agonizing negative 14.9%. To understand how Intel avoids total financial ruin while burning this much cash, we have to look at a highly defensive, seemingly contradictory fortress on their corporate balance sheet. Total liquidity stands at an immense $32.79 billion, combining highly liquid cash and short-term investments. Liquidity just measures how easily and quickly a company can access hard cash to pay its immediate bills. Anyone practicing value investing will panic when they see total debt reaching $45.03 billion on the ledger. They assume this debt load will eventually crush Intel under rising interest costs and operational strain. But when you strictly factor in the $32.79 billion of total liquidity, the resulting debt-to-equity ratio remains incredibly healthy at just 0.36. The debt-to-equity ratio simply compares what a company owes to what it actually owns, showing how heavily it relies on borrowed money. When executing proper stock market analysis, a ratio of 0.36 provides the ultimate financial runway, signaling that Intel faces zero structural solvency risks in the near term. It proves that a company can withstand terrifying GAAP operating margin drops of negative 23.1% as long as its liquidity moat remains impenetrable. Yet, this aggressive cash hoarding strategy leads directly to a ruthless executive decision completely altering the fundamental identity of Intel stock. The cash dividend payout dropped to exactly $0 this quarter, deliberately terminating a decades-long tradition. For anyone focused on value investing, the sudden elimination of a cash dividend payout of $0 and open market share buybacks forces a massive capital rotation out of yield-seeking portfolios. Instead of paying you, management used strategic capital to repurchase a 49% minority equity interest to retain internal control over a vital joint venture. Once you grasp this fundamental analysis, you will start to look at financial reports in a completely new light. Intel is redirecting every available dollar away from passive shareholder returns and funneling it directly into its aggressive global factory expansion. Even with the dividend gone, second quarter gap, gross margin guidance is projected to dip to 37.5%. Gross margin is just the percentage of revenue left after paying the direct costs of making the product, revealing a company's true pricing power. Optimists look at a GAAP gross margin of 39.4% for the current quarter and assume the severe pricing compression is behind us. But when you suddenly encounter a mark-to-market loss on escrowed shares totaling $1.09 billion, the forward outlook becomes violently unstable. A mark-to-market loss simply adjusts the value of an asset on the balance sheet down to its current market price. This $1.09 billion hit introduces dangerous variables into the income statement, proving that heavy reliance on alternative financing carries unique valuation risks. The staggering divergence between accelerating AI revenue metrics and that brutal $3.73 billion GAAP net loss proves Intel is tearing itself down to the studs to rebuild. While the top-line acceleration and immense $32.79 billion liquidity moat provide a legitimate survival runway, eliminating shareholder payouts signals years of agonizing cash burn ahead. That is why I believe that within the next 24 months, Intel will face a definitive reckoning where its foundry gamble either disrupts the global semiconductor supply chain or permanently relegates the company to a second-tier market status. But I want to hear your take. Do you think Intel's foundry investments will eventually pay off, or is this legacy giant burning cash in a race it cannot win? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.